As deficits continue to grow, the bond market feels the stress of that as we have to issue more debt, interest rates go up, and there's no way out. I mean, these people, the people who run the Fed are completely, totally, and utterly fucked. They are going to lose this battle, and the currency is going to ultimately become worthless. And you're seeing them start to indicate that they're going to have to pivot. And I think in terms of an event horizon, we're all of the belief that that pivot has got to come fairly soon.
So that pivot would indicate resumed QE. I like to say QE infinity is inevitable.
On September 18, 2023, the United States national debt reached a historic milestone, hitting $33 trillion for the first time in history. To put this in perspective, just 4 decades ago, the national debt was around $97 billion, meaning it took over 200 years to accumulate the first $1 trillion in debt, and only around 40 years to amass the next $32 trillion. What's even more astonishing is that in less than a month since the national debt hit $33 trillion, an additional $527 billion has been added, which is over 66% of the $796 billion annual defense budget. Maya McInnes, the president of the Committee for a Responsible Federal Budget, aptly captures the absurdity and precariousness of the situation. She points out that the United States has reached a new milestone that no one should be proud of, with the gross national debt surpassing $33 trillion, while debt held by the public has recently exceeded $26 trillion. The enormity of these numbers may have desensitized the majority of the American population, but it doesn't make them any less dangerous. Sound money advocates, such as Greg Foss, James Liu, Lawrence Lepard, and Preston Pysh, individuals with extensive experience in the traditional financial industry, believe that the United States debt burden has grown to unsustainable levels. They argue that the country is teetering on the edge of a massive credit event that could disrupt the economy and severely harm the existing financial system. According to Foss and Liu, the only way out appears to be the government's continued printing of money, a path that drives the country deeper into the debt spiral until a catastrophic financial event unfolds. In a recent fireside chat, these experts shed light on the looming challenges posed by the ever-increasing national debt.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Basically, the debt spiral, if you were looking at the United States Treasury and you considered it, if you were looking at it like a company on the New York Stock Exchange, we would call it a zombie company. Now, what do I mean by that? Well, it means that the company isn't covering its interest expense with its earnings. Okay, so if you look at the United States Treasury, and we look at all of their expenses, you have mandatory expenses like the Social Security, Medicare, Medicaid, and then those are signed into legislation. They have no choice. They've got to pay these expenses, right? Then you've got big expenses that are signed into long-term contracts like the defense spending. When you add those up and you add interest expenses on the debt, they total more than the United States Treasury takes in earnings, which is really just tax dollars, every year. So that creates a deficit. And in the United States, we've been operating in a perpetual deficit for a very long time. And so that deficit leads to us having to borrow more to cover the deficit, which is issuing bonds. And then you have to pay interest on those bonds, and then you have to, that interest that you're paying now creates a larger deficit. And as that deficit grows, it creates a larger interest expense, which creates what? A larger deficit. And eventually it creates the demand for treasuries to fall, which means that you're going to have to pay more interest on that. And as interest rates are rising, you're paying even more interest on the debt that you're issuing, which creates what? A larger deficit. And this is called the
Debt spiral. So, eloquently put, James, people would argue, well, don't worry. The economy is growing just as fast as the debt is. That's false. Total debt to GDP is a very important metric because total debt gets paid by tax revenue on GDP, right? So you have a numerator, total debt, you have your denominator, GDP. The fact of the matter is that your total debt is growing faster than your sales growth or GDP. Larry.
Yeah, so in 2008, when John Law was running the Federal Reserve, Ben Bernanke was running the Federal Reserve, things changed. And the U.S. national debt since that date has grown at a rate of 8.5%, and the GDP has grown at a rate of 4%. That's the fundamental problem. The GDP is necessary to pay the interest on the debt. And so the Keynesian experiment, as we know it, it's toast. It's all over. These guys have been lying. We know it. They know it. They know we know. And we're about to put them in their grave.
So if you want to put a number on it, I'm going to turn it over to Preston here, but if you want to put a number on it, the United States added $500 billion of debt in the last 2 weeks. So now we have borrowed $33.5 trillion. So we just crossed $33 trillion, and we just added another 500 to it in 2 weeks.
I just want to put context on that number. So we hear these numbers, 500 billion in the last 2 weeks. And for most people, they're just like, oh, that sounds like that's a really big number. If you look at the Department of Defense, they spend, what, 700, 800 billion in a year, okay? We have added 500 billion, almost that same amount in the last 2 weeks. So to really like wrap your head around these numbers, think about the meme when people post on Twitter of like the aircraft carrier going through the sea with the fighter jets and all the training and all the personnel and all the bases. You go to Texas, there's a road at Fort Hood. It's 7-8 miles long with tanks for 7 or 8 miles. To fund all of that, the people, the material, the R&D, all of it, $700 billion. We've added $500 billion in the last 2 weeks.
Few people seem to be giving significant attention to the rapid descent of the United States and the entire global debt-based monetary system, a sinking ship weighed down by the recklessness, short-sightedness, and avarice of policymakers. However, for those who are vigilant, the hard-hitting facts are becoming increasingly difficult to overlook. Sven Henrik, a seasoned financial market strategist, recently shed light on the situation in a post. He highlighted the striking reality that the top 0.1% took 17 years to amass $6 trillion between 1990 and 2007. Subsequently, it took them just 11 years to acquire the same amount after the Great Financial Crisis. Shockingly, it took a mere 2 years for the top 0.1% to accumulate another $6 trillion following the pandemic. All the while, the middle class continued to dwindle, showcasing the true legacy of Federal Reserve policy as the principal driver of wealth inequality, as noted by Stan Druckenmiller. In essence, this astounding wealth creation primarily benefits the affluent, while for ordinary Americans, the dizzying rate of currency devaluation translates to nothing short of complete and utter financial destruction. In the coming years, this trend is anticipated to accelerate at an even more alarming pace, as emphasized during a fireside chat. As we delve further into this matter, it's crucial to understand the staggering implications. In 2022, the interest expense amounted to approximately $600 billion, but in the current year, it's just below $1 trillion. If interest rates remain at their current levels, projections indicate that by 2026, it could surpass $2 trillion. This looming scenario is explored in greater detail during the fireside chat. These discussions illuminate the urgency of addressing the mounting challenges within the financial system, and they serve as a wake-up call for those who have been unaware of the profound consequences of the ongoing economic policies.
Fundamentally, what we have here is a sovereign debt crisis, and the United States is starting to look like a third world country. You know, we've seen this pattern before. This is not new. We've never seen it in the world's reserve currency, which is what we have here. But we've seen it in Argentina, we've seen it in Venezuela, we've seen it in Zimbabwe, we've seen it in Weimar, time and time again. And the fact of the matter is that as deficits continue to grow, the bond market feels the stress of that as we have to issue more debt, interest rates go up, and there's no way out. I mean, these people, the people who run the Fed, are completely, totally, and utterly fucked. They are going to lose this battle, and the currency is going to ultimately become worthless. And you can kind of see that. I mean, in Powell's most recent presser, he said he's navigated under cloudy skies with a sextant. I mean, dude, we've got GPS. I mean, what the fuck? You know, I mean, the guy has no clue what he's doing, and you're seeing him start to indicate that they're going to have to pivot. And I think in terms of an event horizon, we're all of the belief that that pivot has got to come fairly soon.
So that pivot would indicate resumed QE. I like to say QE infinity is inevitable. But with resumed QE, what you have is accelerated fiat debasement.
Something that's really important to understand is we keep talking about QE and how the Fed's going to pivot, they're going to provide liquidity to the market. This is all, the reason why they must do that is exactly what we're talking about. The Treasury must have a market that will buy Treasuries. It must stay liquid. It absolutely has to have a place to dump all of these Treasuries. And you're seeing the rates of the Treasuries rise on the long end, looking for price discovery on where these rates are going to go, because they know that the Fed or the Treasury has to have a market for them. It cannot break. So when we talk about QE, quantitative easing, what we're talking about in simple terms is the Treasury pushing a button, putting a bunch of money on the Fed's balance sheet. The Fed tells Citigroup and JP Morgan to go buy a bunch of bonds in the market. We're going to buy them back from you today. The Fed gives them the money and then turns around and holds the Treasuries on its balance sheet, right? So that's QE. They're literally monetizing the debt. And we've seen this happen in Japan, where Japan owns, the Bank of Japan is the largest owner of its own debt. Think through that for a second. They own more than 50% of its own debt. So that's where we're headed as a country.
And as Greg says, it's just math. And historically, we've seen this many, many times. We saw it in 2008. We saw it in the repo crisis in 2018. We saw it in March of this year. I mean, the Fed actually arguably already has pivoted. BTFP was a small pivot. And so we know that their third mandate, their two mandates are obviously full employment and inflation. They failed at inflation, obviously. We know their third mandate is keeping the system functioning. And every time it doesn't function, they do the exact same thing, which is they pivot. And I want to just read 3 headlines. These are just from yesterday. Nick Tamaros in the Journal. If the bond market keeps this up, the Federal Reserve will have less of a reason to hike rates again. Wonder what that means. Wall Street Journal headline yesterday. Rising interest rates mean deficits finally matter. Bond sell-off might force the Fed to rethink shedding assets. What does that mean? Okay. Breaking markets. Fed's daily. With the rise in bond yields, the need to do additional tightening by the Fed is not there. What does that mean? These fuckers are going to print. They're going to print until their fucking eyes bleed. And we know it's going to happen. And so all we've got to do is outlast them and then watch them as they suffer.
Recent estimates indicate that tax receipts have fallen by approximately 10% this year, raising concerns among more and more economists that the economy is on a trajectory toward a recession. By the end of the third quarter in September, a total of 516 companies had filed for bankruptcy. To put this into perspective, in 2020, there were 518 bankruptcy filings recorded through the same period, which means that the pace of filings this year has been nearly identical. If this trend continues at the same rate for the current quarter, 2023 could easily surpass 2020 as the worst year for corporate bankruptcies in over a decade. This worrisome scenario has led experts like Greg Foss and other panelists to firmly believe that the United States is on the verge of a substantial credit event within the next 12 months. Such an event would likely necessitate further monetary printing by the Federal Reserve, exacerbating the root causes of the crisis. As a result, the nation would find itself in a cycle of successive crises, each larger than the last, with brief periods of deceptive relief in between. According to these experts, the only individuals well prepared to navigate these challenging times are those who have invested in hard assets like Bitcoin. Foss advises considering the mathematics, as the debasement of fiat currency is virtually certain. Bitcoin serves as insurance against this outcome, implying a strong likelihood that it will not only survive but thrive in the face of what lies ahead. The insights provided in this illuminating fireside chat paint a grim yet accurate picture of the United States economic landscape. It underscores the importance of preparedness and the potential role of assets like Bitcoin in safeguarding one's financial future. What are your thoughts on this discussion and the concerning outlook for the U.S. economy? Please share your comments and observations below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.